Hello, in this video we are going to talk about financial decisions. The module objective is to help the learner understand what is a financial decision and the different types of financial decisions. At the end of the course, you will be able to understand decisions pertaining to financing, investing and dividend distribution. Basically, there are four types of financial decisions. First, a financial decision is any decision that is relating to financial matters of a business concern. The four types of financial decisions are capital structure decisions, also called as capital mix decision, capital budgeting decision, otherwise also called as investment decision, then the dividend decision and the working capital decision. First, we will see only about the capital structure decision. As I earlier said, it is also called as the capital mix decision. When you take this decision, you have to think of three major criteria. One, what are the sources of capital? What is the cost of each of that capital and the capital mix? Now let's pause and think about the sources from where you can get finance if you intend to start a business. Probably you might have thought of using your own funds or getting your friends' funds or borrowing from a bank. So you have own funds or retained earnings. You can issue shares. In the case of a company, you can issue shares. It may be equity shares or preference shares, or you can take loans, maybe from a bank or from a financial institution. Now, what are the advantages and disadvantages of each of such sources of funds? If you use your own funds or your own resources in an organization, it will be called as retained earnings. The points that are for or what are the advantages are, you are self-reliant. That is, you don't have to borrow from somebody else and there is no outside intrusion. So once you don't borrow from somebody else, they cannot intrude and exercise their force upon your business. But the disadvantage of using own resources are you cannot scale up. When I say you cannot scale up, it means you cannot expand your business. Your funds may be limited, so you cannot make your business grow. And also this risk arises when there is only a single owner. If something happens to you, the entire business also collapses. So these are the advantages and disadvantages of using your own resources as the capital of your business. Next, suppose you issue shares. That is, you invite a lot of shareholders into your business. What happens? You get a lot of funds. The advantage is you can scale up your business. That is, you can expand your business and you need not rely on your own resources. Even if your own resources are not there, there are the shareholders who can provide you the funds. But the disadvantage is there is a divulsion of ownership. That means you are no longer the sole owner. The shareholders also become the owner of the company. And you have to pay them dividends. They just don't give money for free. You have to pay something back to them. So that in the form of a dividend. Now, you have seen your own resources, then you have seen the shares. Next one is when you issue debt, when you take a loan or you raise a debt. The advantages are you need not commit your own funds. Again, you are getting it from somebody else and you need not divulge ownership. When you take shares, when you issue shares, the shareholders become the owners, but those who provide loans to you do not become the owners. And you can leverage the advantage of debt. If you use debt wisely, you can leverage its advantages. The points against using loans or debt is there is a fixed periodic payments. Whether the business is running or not, you have to make periodic payments every month or every year or every quarterly. This is generally called as the interest. And sometimes it may be very costly also. Next is it does not give a good image. If suppose you have a very high debt component, then it becomes a very bad image in general in the credit market for you. So we have seen the three types of capital and the advantages and disadvantages of each source of debt. So here is what, so that is regarding the sources of capital. Next is we are seeing about the cost of capital. So each of the capital that we saw has its own cost. For equity, the cost is what? You have to pay them dividend. For debt, what is the cost that you have to pay? You have to pay them interest. For retained earnings, what is the cost you have to pay? It is almost similar to the equity. So in this chapter, we have seen about the financial decision. What is a financial decision? That is any decision relating to financial matters. What are the 4 types of financial decision? And among them, we have seen the first decision, that is the capital structure decision. Thank you.